Atocha Global Analytics. Please like and subscribe. Greetings, salutations, and howdy to you all. I'm KT with Atocha Global Analytics. Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. Welcome back to Forecast Friday. This is our once weekly segment, and this is the Friday, August 11th, 2023 edition. And here comes the latest. International economics is again a challenge that is imperiling the U.S. It's a mixed bag, but I can't say that without adding some substance here. U.S. growth is still bifurcated. It's GDP is positive, but GDI is negative or on the edge of negative. They've still diverged. And with a bunch of indicators pointing toward a recession, a bunch seemingly showing continued positive growth, although the conference board, is forecasting a U.S. recession starting this quarter. My personal expectation is, presuming no big black swan event, the GDP will actually remain positive at least until the fourth quarter. Government spending is totally untethered after June's debt ceiling deal, and I think that the powers that be will spend lavishly to try and prevent swinging the election away from the current crop of dunderheads in D.C. So that's my 2 cents. Just a quick blurb here. Oil is moving higher again. The IEA said demand should rise in August, and demand for all of 2023 should be 102.2 million barrels a day. That's a new annual record, up about 2.2 million barrels a day from last year. So China is where the bulk of that growth came from, about 70% of it. And a spokesman of the IEA noted that the demand was stronger than expected in China, and the new highs were, despite the persistent concerns over the health of the economy there and elsewhere. So oil hit $88 a barrel yesterday, up from $64 a month ago. Higher energy prices, those hurt everyone, and it slows the economy. And so, the CPI will rise as this is felt at the consumer level, meaning July's rise may not be the last we see of inflation. Whether that's enough to cause GDP to go down enough to move us towards recession, that remains to be seen. Something else I've noted here for weeks is the risk of overseas economies impacting us. So let's cover that real quick. A recession has long been forecast in the EU for a variety of reasons, but here's where things currently stand there. By the traditional definition, the EU slipped into recession earlier this year due to 2 consecutive quarters of negative GDP. But they're saying it wasn't really a recession, similar to what we were told about our economy here in the first half of 2022. Though the EU technically eked out a narrow 0.3 GDP growth rate in the most recent quarter, revisions may erode or reverse that later, just like it is often done here. These revisions oftentimes tell a different story. That all said, semantics are really less important in this at this point. Simply, it's pretty tough right now in Europe, and a recession is still forecast to start in the EU this year as well. Okay, some further evidence of the issues over there. Investors have been shifting their investments over here to the U.S. from European markets for some time, which kind of inflated our stock market levels. The S&P specifically, it rose about 20% this year at its recent peak. It's still at about 17% for the year. But the stock market overall has recently become a little bit more volatile as the rising risk of domestic economics challenges are really starting to take hold with U.S. investors, and the confidence in the U.S. government's policies have eroded amongst investors actually worldwide. So the euro has declined against the dollar just a matter of about 2.6% in the last few weeks, which is a pretty rapid move. So confidence is in the U.S. more than the EU, but even that is starting to be shaken a bit. Okay, so before we move on and I show you what's up in China, please like, subscribe, and ring the notification bell. Appreciate that. Well, a big shocker here. China's exports are down again in July. according to the government data that was released this week. And this is a sign that China's economic recovery is not happening, and the efforts by Beijing to revitalize growth are not having any notable benefit yet. This is an interesting aside. Out of the six themed stories in my feed last night, three of them were about China economic issues. The titles were China's falling prices are a more profound problem than U.S. inflation. China's hailed a property developer with 64 billion in revenue as a role model. Now the country's property crisis threatens to send it into default too. And the third story was China's heading for another real estate crisis, but it's on a whole different scale than what it's seen before. So those are the three titles. So I sourced all this stuff that I'm covering today already. So the algorithm was prime, but this news is everywhere overseas. It's just been fairly muted here in the US. So internationally, this makes sense. China is the world's second largest economy, second only to us in the United States. And, it's seen its exports decline for 3 consecutive months, while imports have fallen for 5 consecutive months. Demand for Chinese made products is clearly down. Plus, they have falling domestic demand, a real estate crisis, geopolitical tensions, and the tertiary impacts due to the war in Ukraine. So, Nomura economists expect exports to fall for the rest of 2023. Here's what they said. These readings point to worsening growth prospects, followed by a worsening export contraction means weaker production, while rapidly deteriorating imports reflects weaker demand within China. So here, let me share some stats with you. China's exports are down 14.5% in July year over year. The imports fell 12.3% in the same period. Through July, exports to the U.S. specifically were down 18.6% year over year, and to the EU, down 5%. The bright spot, exports to Russia, after being hit by the Western sanctions due to the invasion of Ukraine, those exports are up more than 70%. So China has been benefiting from that. Somebody I follow regularly, Paul Donovan, he's the chief economist over at UBS. He said to investors recently, there's been a general weakness in demand for China's exports. Beijing has been working, and that's all he really said. But the Post expanded what he said in context. Is here Beijing has been working to inspire post-lockdown rebound with no discernible success. The Chinese real estate crisis and weak spending by Chinese consumers have undermined growth initiatives, and Beijing is attempting to increase exports to help stimulate the economy organically. This week's trade numbers and further weak demand will exacerbate the global slowdown. So yes, it's continuing to be a problem. And, China's been throwing all kinds of options at the wall to see what sticks. But before I show you what's up China's sleeve with that, please like, subscribe, and ring the notification bell. And so with that, here's some options China may use to attempt to boost their economy. Some more direct stimulus. After the Great Recession, Great Financial Crisis back 2008-9, China released a massive 4 trillion yuan, which is about 550 billion. And they released this massive stimulus plan that resulted in an infrastructure boom of new roads, airports, high-speed trail lines, and a bunch of ineffective port projects, along with a bunch of debt, just like we get here. Now, China, they're doing things, they're being a bit more targeted. Last month, it was measures to inspire purchasing electric vehicles and household appliances. So they're trying to get smaller direct purchases by consumers to increase. But they've got another issue here, sluggish consumption. China recently announced some large-scale festivals and sporting events to try and spur consumption, and to increase spending on services like catering, healthcare, etc. This may prove to be a fool's errand, though, as Chinese consumers aren't spending because income growth has declined and the economic forecast is vague to bleak. On top of that, high youth unemployment, which is currently an official 21%, but some say could actually be around 45%, is making challenges worse because that's who goes to a lot of these events and festivals is younger people. Another issue that they're fighting, they've got a deflationary spiral right now. Deflation has been showing up in China data for a while, but now they're finally starting to report it. Of course, falling prices sounds good for purchasing power, but deflation actually creates a longer term risk as consumers begin to delay purchases, hoping for some lower prices. And this may become a loop. If it worsens, it may affect the employment numbers, and that's how it ends up spiraling down. Um, Now, here's the biggie here: the property crisis. Real estate has been a big part of the Chinese economy, accounting for as much as 30% of the country's GDP for many, many years. Yet developers are struggling right now, which is causing a crisis of confidence amongst buyers, and it's undermining prices, etc. The Chinese central bank recently extended support for developers until the end of 2024 and extended loan repayments to allow developers to complete their existing projects, get paid, that sort of thing. Also, some urban areas have eased the purchasing regulations to inspire activity, but the benefits have proven muted, at least thus far. Now, reports this week indicated that one of the largest private building firms in China, what was once the largest, Country Garden is the name of it, and they've built over 3,000 developments over there, and it was four times. This company right now is literally four times the size of the largest ever default in China, namely a company called Evergrande. Well, Country Garden missed their interest payments on two dollar-denominated bonds, and the markets are pretty spooked by it. And it's not just Country Garden either. Many developers have accumulated some really problematic debt, as demonstrated 2 years. What happened when Evergrande collapsed. That resulted or triggered a series of defaults. But the debt may be so high now, and too high now, to avoid serious systemic issues. So Country Garden, again, which was once China's largest developer, but slid to fifth in the first half of 2023. Their share prices for the firm have plunged 16% just this week after reports by Reuters and Chinese media noted that it had missed those interest payments on those $2 denominated bonds. But trading on several yuan denominated bonds were suspended on Tuesday after dropping more than 20%. So this is contagious to the entire sector there, and it may seriously harm the $5.3 billion fortune of the grand poobah of Country Garden too. So trade issues, China is highly dependent on exports, but the threat of recession in the U.S. and EU, along with high inflation, has really undermined and curtailed international demand. In order to support exports, Beijing may choose to depreciate the yuan against the dollar like they have in the past. But again, that's not necessarily a real productive thing to do. Another issue, geopolitical tensions. Now, with some leaders, advocating a decoupling from China due to tensions with Beijing, this is hurting their growth as well. According to Goldman Sachs, direct investment in China from foreign sources in the second quarter of 2023 fell to the lowest level since 1998. So money is not flowing there. Opinions range, but China doesn't seem to have many truly beneficial tools left in their toolkit, and its pain is infectious. Europe is suffering because of China trade issues and the rising cost of capital. So, and with that, let's move to the Forecast Friday tables. Again, please help us out by hitting the like, subscribe, and ringing the notification bell. I thank you for that. So the Forecast Friday tables are actually a bit light this week. It just fell where there weren't that many announcements, but we do have the weeklies and a couple of monthlies scattered throughout. So the Baltic Exchange Dry Index moved up nicely this week. It's doing okay on the quarterly, still down quite a bit on the annual basis, but it is recovering somewhat. I had added the Drewry World Containerized Index Composite, and there's a bunch of smaller ones, but just use the composite. It tracks just by price, and again the index up very slightly this week, down big quarterly and annually, just massive. Monthly, it is still down, but anyway, it is moving at least slightly up in the last week. Monthly rail traffic came in. Usually, it's about a 6 week lag, so they're really ahead of the curve. They released July's already, so they may be getting up to speed where they released within a couple weeks of the end of the month. The news is it's down somewhat substantially on a monthly basis. It's up a bit quarterly. But it is, if you look at the graph, it is a noteworthy slowing. We are just above December levels, so we're the lowest that we've seen at all in this calendar year. China, the China Containerized Trade Index, it is showing some nice moves on a weekly basis. It's up a little bit overall. Europe is up notably. Eastern U.S. is up slightly. Down a little bit in the Western U.S. So it's a mixed bag, but again, still down quarterly and annually as measured. The FreightWaves National Trucking Index, it literally went up a penny and down a penny the last 2 weeks. So that's what you see reflected there. The 10-year Treasury spread. It's improved slightly. As you see, it's 0.7%. That's actually literally from negative zero point -0.8 to negative 0.73. So it's moving in the right direction, but still much to go. All right, so moving on to the second panel. Just a few items on the second panel. The MBA Mortgage Application New Purchase Index did move up slightly this week, but it is down quarterly and annually still. It's not moving very far, very fast. Mortgage rates are still somewhat high. We're out of the selling season, so it all makes perfect sense there. The average weekly hours, both monthly and the average weekly initial claims came through. The hours worked down slightly. It was literally much like the freight waves. It was up 1/10 of an hour, down 1/10 of an hour. So that's what you see reflected in the monthly number. And of course, the initial claims are, down, so that is an improvement on the overall numbers. And with that, actually, there is absolutely nothing on the third panel to focus on. So it was a very quick Forecast Friday tables. So we've covered all we can today. Yet another Forecast Friday. It was more involved than intended. I know everyone is always shocked by that, but all of this matters. Again, if you believe anything happens to be worthy of being included on this list, please include it or suggest it in the comments. Thanks for sharing the journey. Until next time, ciao. Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.